that was basically a huge change. Not a lot of people saw that coming. We were in early on it, and
the Bakken shale.
Real
those
early,
and
just absolutely crushed it in hydraulic fracturing. Oil sands technology, but mainly the Bakken. And like the natural gas plays.
Yep.
So, I mean, is it fair to say this is very similar to that sort of things? Because it's like all you hear is, we need all this lithium to run these things, blah, 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 blah. So it seems like now's the time to get in on basically this is like new this is fracking for lithium, I guess.
It sort of is. And honestly, I think it could be bigger than that, because the one extra thing that you have tied onto this is that not only does it make lithium mining more efficient and more profitable, but it also makes it more environmentally friendly.
Welcome to the Angel Research Podcast. My name is Jason Freert. I'm here with another Jason. There's a lot of Jasons around Angel.
It's a good strong name.
Jason Williams. Thanks for joining us today, Jason.
Yeah, of course.
I want to jump right into it. We were just talking about dividends.
We were.
Right?
We were.
And, last week, or maybe it was 2 weeks ago, I had a conversation with our president and co-founder, Brian Hicks.
He loves dividends.
Yes. He loves dividends, and he was shared with the audience a couple of the dividend stocks that he owns, a lot of oil and gas stuff. And it was funny. We posted it out on social media and got a lot of comments. Some of them were weird, but I think there was a lot of questions and a lot of misconceptions about dividends. So I kind of wanted to ask some more specific questions because, the basics are, you own a company. You have, say you own 100 shares of, we were just talking about Disney, and they pay X% dividend, and whether it's a monthly or quarterly, sometimes they do yearly, you just get paid out that in dividends, correct?
Yeah, exactly.
So I guess I think the misconception too is a lot of people are thinking, oh, well, why should, if I want to make money off of dividends, why shouldn't I just pick a stock that has the highest current dividend yield?
Right.
So he talked about, this one's at 8%, and people were like, oh, well, this one's at 12%. But it's a little bit more complicated than that.
Well, yeah. So, it definitely is. And there's things that dividend investors call yield traps, right? And that's basically, it's a company that has a high yield, but, you're not going to make money off of it because, they're going to pay you 12% a year, but the stock price falls by 24% a year. So, net, you're down. And those are yield traps, and it's that big percentage. People see that and they're like, wow, that's awesome. I want to get that. But the thing is with dividends is that yield, that percentage that they show is what the annual dividend is as a percentage of the current stock price, right? So if the company was paying, $1 a share and it had a $100 stock price, then, you've got a 1% dividend yield.
Right.
Now, if that same company's stock price drops down to 10 and its dividend hasn't been cut yet and it's still $1, well, that looks like a really awesome, 10% dividend there. But, the company also just lost 90% of its value.
Yeah.
So, those are some of the companies with a high dividend yield have that high dividend yield because they were paying big dividends when they were worth a lot of money and they haven't cut their dividend yet.
Right, exactly. So it's probably more likely that not only has the share price dropped, but that's usually because the company's struggling,
right?
And
Revenues are dropping, profits
and
are
they're
dropping.
likely to see a dividend cut because they only.
Well, and that's the thing is that if everybody's buying this stock because of that high dividend yield, when they do finally cut the dividend, man, if you thought the stock price had fallen a bunch before, just wait. It's going to crash.
Right. So, and they can, pretty much at any time a dividend or a company can cut its dividend.
Yeah.
I know they try not to go from 0 to, or 5% to 0. They'll try to slowly cut, especially if they're known.
Or they'll suspend it. They'll be like, we're going to suspend the dividend because, we're just not sure if we're going to have the profits to pay it this year. So like a lot of times they'll do that, but then, those suspensions like last, forever. But yeah, there's only one kind of company in the market that actually can't stop paying a dividend. And it's my favorite kind of company. It's actually, I'm pretty sure it's one of Brian's favorite kind of companies too, and they're real estate investment trusts.
Okay, yeah, so those are the ones where they're basically legally obligated to pay you.
They are legally obligated. So they're a real estate investment trust is technically not a company. Right?
Right.
It's not like your traditional like incorporated or LLC or whatever. It's a completely different structure. And basically, they have a lot of rules that they have to follow. They have to have a certain number of shareholders outside of like, the immediate insiders of the company. They have to, the majority of their assets have to be invested into some form of real estate, be it buildings or land or, farmland, whatever. But the really cool part about it is that by law, they have to pay out 90% of their pre-tax profits to shareholders. And so that's one of the reasons that they have to have so many shareholders outside of the insiders so that like you can't just use this structure to make yourself rich.
Gotcha.
And you can still got to be sharing that. And it's really like, it was basically the idea behind it was to sort of democratize real estate investment back in the 1930s. It was really difficult to invest in real estate. Only super rich people could. But like, if you can scrape together $10, $15, $20, you can buy a share of a real estate investment, like a real estate investment trust. And then technically you are invested in that real estate. You are a partial owner of the real estate that they own, and they're obligated to pay you, those dividends that they get, or some of the revenue that they get from renting that real estate out. It's like being a landlord, but not having to deal with tenants.
Yeah, and you can buy these on the stock market just like any other stock.
Just like any other public company, but they have to follow somewhat different rules in order to maintain that REIT status. And the nice thing for the company about the REIT status is that because they're paying out so much of their pre-tax profits to investors, they don't have to pay taxes.
Right. So that's kind of the deal.
Yeah. So if they do cut their dividend, then all of a sudden they lose that favorable status, and their tax bill goes up, and nobody likes to pay taxes.
No, everybody's
trying the whole country trying to not pay taxes.
Yeah. Everybody's trying to limit that tax liability while still getting the income.
Yep.
So that actually brings up something else we talked about, which is another. So Brian talks about, getting a check every month for these companies that he owns. I asked him, I was like, do you physically get a check? He was like, yeah, I physically get a check. I'm like, really? You don't have like direct deposit? I think it's just, if it was me.
It's super old school. I mean, if you actually, so most people invest in stocks through a brokerage, like an E-Trade or a Fidelity or something like that. And when you do that, technically you don't own the stock. Fidelity or E-Trade will go out and buy the stock for you, and it's held in what's known as street name. So E-Trade, according to the stock market, owns that stock, and then they've sort of got like a spreadsheet in the background, and they're like, oh, Jason Williams owns this much of it, and Jason Freard owns this much of it, and, like Tom, he owns like this percentage of it, but really it's all in their account. Right. So in those cases, usually the money just gets directly deposited like electronically into your brokerage account.
Right.
But when you actually buy the stock from the company through their transfer agent, which we were talking about this earlier also, and I mentioned that CompuShare is a big transfer agent, and they do a lot of these programs for most of the big companies out there on like the NASDAQ, the S&P 500, the Dow. They handle these programs, and basically you can go and you can buy stock directly from the company. So you're not buying it from some guy on the market who used to own it and now wants to sell it. You're buying it from the company. It's new shares. The company's releasing them. The company's getting money back. And then you actually own that stock. And that's probably where Brian's getting those checks, those physical, because those ones actually come as physical checks.
Right.
They get mailed to you every month, quarter, annually, however often the company pays those dividends. And I mean, they're awesome. It's great to get those checks, especially, if you don't have a job, if you're retired, if you're, on hiatus, or you just need a little bit of extra income always comes in handy.
Yeah. And if you're using that to supplement your income or as your income, that's one of the reasons you want a stable company that has a history of paying. You don't want to go
chasing those high yields.
Exactly. Has a history of paying that dividend.
And raising that dividend. That's the really important part, is raising that dividend, because the stock price is going to follow that dividend too. If they keep hiking the dividend, that stock price is going to keep going up too.
Yeah, that's so, take a 6% dividend that has paid out a dividend for the last 15, 20 years over some stock that has gotten crushed because maybe they're in a business where, they might not be around for too much longer, and they have a 12% dividend, but they might only have a 12% dividend for the next 3 months, and then you're looking at nothing.
No, exactly. Like Blockbuster might have been paying like a 50% dividend, but it's not paying it anymore. And like anybody who had any shares of Blockbuster, like the equity holders lost out entirely when the company went under.
Our young people might not even know who Sarah, do you know what Blockbuster is?
Well, everybody knows
she's giving me a
there's
weird
one
look.
Blockbuster left in the world, and it's like famous. There's a show about it now.
Gotta go get a picture there, take a vacation there.
They had a really great Twitter feed for a while. They were like, "How do we get Blockbuster and chill to become a thing?" Hashtag last Blockbuster on Earth. You're exactly right. That's why you want to get these big stable companies, that have a history of paying their dividends steadily and also have a history of raising it steadily.
Yeah, that's awesome when it raises. I mean, you're making $1,000 a month or a quarter, and then all of a sudden you're making $1,200.
Oh, it's great.
My in-laws actually the sort of oil and gas side of that. I believe is called an MLP.
Yeah,
a lot
MLPs
of times, master limited
like
partnership.
Investment trusts.
Yeah, I think they operate kind of in the same thing where 90%
of
the. So that's where, and that's what like Brian. I think some of those might technically be MLPs. I don't know
I would
the
imagine
exact.
they are. There's a lot of those in the oil and gas industry.
Yeah,
most of those companies pay dividends too. And I mean, I like a company that pays dividends because basically what that says is the company's decided like, okay, like we've reinvested into our growth as much as we can, and we don't think that our shareholders are going to get as much value out of us reinvesting anymore as they would get out of us just giving them a share of the profits, and then they can do with it whatever they want to. And one of the things we were talking about earlier was like, Brian gets these checks, but you don't have to get checks. You can actually have the company reinvest that money into more shares for you. So, with more shares you get, the more dividends you accumulate. And so, if you don't need that cash right now, then you can just sort of let it keep like rolling.
Yeah,
it's like a snowball going downhill, and it gets bigger and bigger.
It's amazing how many people don't know that. Yeah. So I'm assuming, if you have an online brokerage, it's just something that you contact your online. I mean, it's probably in the interface, but if you're using that CompuShare, you'd have to basically just call them up, right?
You literally call them up. You give them your account number off the statement that you get when you get your dividend check, and you're like, hey, look, I got these shares and I'm getting these checks, but I'd honestly like to get into a dividend reinvestment program with them. You still have to pay taxes on the dividends. I think it's a 15%, tax on dividends, which is great because that's lower than most people's income taxes. So that's nice. You're getting this income, but you're not actually paying like that high income right now. If some people have their way, you might be paying a higher tax on them. But
yeah, so I mean that's great if you don't need that money right now for income, and say maybe you're 5 to 10 years away from retirement, and you just say, hey, I want to invest this now and grow and then you have that much more of a base for when you actually want to start receiving that as income. Down the line.
I mean, say you own, like 100 shares and you're getting, like a couple $100s a year, from your shares. Or let's say you own 100 shares and you're getting $1,000 a year. If you're just reinvesting that in, say you're getting that $1,000 a year, you own 100 shares of a $100 company and you're getting $1,000 a year, that's not a really high dividend, but that's 10 extra shares every year. So, you do that for 10 years and you've got 100 extra shares. So now you own 200 shares. And
it's likely the share price has gone up as well.
Yep, the share price has probably gone up. The dividend, if it was a good company that grows their dividend, has probably gone up too. So now you're getting like $3,000, $4,000 a year in your dividends. You do that for another 10 years, and all of a sudden, you're getting like a good monthly income that you could literally live off of. And I mean, that's my goal. Like, I want to be able to have income streams that I can live off of. I love what I do here, but I like making money when I'm not working too.
Absolutely. It's funny. There was a news article out, I think last week. I forget where it was, but it talked about Charlie Munger.
Okay.
And I think there's a lot of news because they just had the Berkshire Hathaway meeting and all that kind of stuff. And he must have said it at the meeting. But basically, the story is he invested, I think, $1,000. I forget what company it was in 1968.
Okay.
And he now makes $70,000 per year
That's amazing.
off in dividends.
Yeah.
Okay. So I forget what the stock was. We'll have to figure it out, but that's incredible. Obviously, 1968 is a while ago, and $1,000 in 1968 is, a lot more. It's probably more like, I don't know, like $10,000 now, but
still
a relatively
less than 70.
Right, a relatively small investment now he's earning in dividends more than the average income, in the United States.
Yeah.
So it's just,
I think that's like the median household income in the area.
Yeah, it's like 50.
At,
it's like 55. Or I don't know what it is, but it's insane. So, you mentioned this earlier about the idea of like everybody wants to, hey, I want to get rich quick.
Yeah, I want to get rich tomorrow.
Yeah, and it's
I don't blame you. I'd like to be rich tomorrow.
Yeah,
That'd be great,
everybody does.
I'd like to be rich yesterday.
Yeah, but if it was that easy, everybody would be doing it.
Yeah, exactly.
So I think a lot of people fall into this trap of like, oh, well, what do you mean? I got to put up $10,000 to earn this, or I can't use that money. I need it for other stuff. If you just put a small amount away into these dividend stocks, and especially if you're doing a reinvestment program, in a year, 2, 5 years, you're gonna look back and be like, oh wow. Okay.
No, you're gonna be really impressed. I did just a study just to satisfy my own curiosity. It was probably like 2 or 3 years ago. I think it was in 2020. Everything was locked down. I had extra time on my hands. I was like taking online courses and just like modeling stuff and like trying to figure out what was going on and just I like data. I like numbers. I love this stuff. I love finance. And so I took 3 stocks that were what I consider to be household names back in 2010. It was Apple, Microsoft, and Broadcom. Right. And so Broadcom might be the one that maybe wasn't quite a household name, but like people probably knew about it. But Microsoft and Apple, like everybody knew about those two. Right. And so what I did with my model was I put $10,000 into each one of these companies. And then I added $1,000 a year to each of those companies for 10 years. Right. So over the course of 10 years, if you include my initial $10,000 investment, plus the $1,000 a year for 10 years, that's $20,000 I put into it. Apple, that position was worth something like $250,000. The Microsoft one didn't come up as much. It was worth around $170,000. The Broadcom one was worth like $450,000 because they just, they did really, really well. Their stock price went up a bunch. But, like these are household names. These are not, secret stocks that nobody knew about. And you could have literally, if you just stayed in Apple for 10 years, stuck to a schedule of putting $1,000 in a year, didn't try to time the investments or anything like that, you could have turned $20,000 into a house. That's like
insane.
turning a roller skate into a Lamborghini. It's amazing, and like that's the power of these dividends, because all of those companies paid, and Apple didn't even start paying dividends until partway through that, So
yeah, that's crazy.
It's really impressive the power of the power that dividends can have.
And I think, look, the small stocks are exciting. I get it. And
they are.
You want to, we try to make the distinction here between sort of what we call investing and speculating. Okay? Speculating is fine.
Oh, totally fine.
And I think, you can make some really huge returns in a short period of time if you sort of get in front of the trend.
Yep.
But I think even the people, we have them here, that take a look at these, they're not suggesting or themselves either putting like 100% of their net worth into these plays. I think the majority of people's portfolios here and what we put out is in some of these safer, dividend players. You can still, beat the market and do well, picking those, but there's kind of, there's these other like sort of moonshots as we call them.
Right.
And, you can make 10x in a very short period of time. Yep. So it seems to be that, you just want to make sure that you really aren't putting, all your money into these things and
Yeah.
thinking that, and that's, I think, where we talk about the get rich quick, right?
Definitely.
You know?
And I mean, every single editor here, I'm pretty sure every single person, who gives, I don't want to say gives investment because we don't give personalized investment advice, but every single editor here has, at least one quadruple digit gain. Some of us have multiple. But the thing is, it's kind of like, some people like to go to Vegas. Some people like to buy lottery tickets, and like you can win a lot of money in Vegas, and you can win a lot of money at the lottery. Somebody just won like the Mega Millions jackpot for like $1 billion or something. That's tons of money. But the thing is all of the other people who played didn't win. And like, look at the size of the casinos in Vegas. Look at how lavish the appointments are there. Like, you really think that they're not making money? You really think that everybody's winning when they go to Vegas? Like, they're not. And so, like, but that's okay, because like you can have fun. It's enjoyable. Some people like to go skydiving. Some people like to climb mountains. Those involve a lot of risk too. So it's okay to take some risk.
Yeah, and if you're comparing, taking a flyer on, a not unprofitable company that has a new technology, your odds are actually much higher in the market than it is at the craps table or all that kind of stuff. So you have a little bit of that advantage in there. It's just you don't, just the same way, and some people do this, you don't take your life savings and go to Vegas. You take a portion. Hey,
if I come back with none of this, I'll still be happy.
I'm going to take $1,000. I'm going to play some games or whatever. If I lose it all, it doesn't affect me. I had a good time. If I win, then that's great, and it's a bonus. So the same sort of way, that's the same sort of, in my opinion, the way to look at some of these high flyers that we're looking at.
That's exactly how I set up my own investments. I've got my retirement account over here, and I contribute to it regularly, and I invest in dividend-paying companies that grow their dividends. But I don't put any of those speculative stocks in there, because that's the money that I gotta have that, because I don't want to work forever. I love working, but eventually I'm just not going to be able to. Or AI is going to take my job from me, something like that. But so like that money's over here, and then there's another account where it's like extra money. It's like, this is sort of like fun money, like maybe instead of going on an extra vacation this year, I take that $5,000 and I split it up amongst 5 penny stocks that I think have really good potential, that I think are going to just like grow and become giants in the next few years. And but the thing is if I lose that $5,000, in the greater scheme of things, that's not that big of a deal,
right?
In like the big lifetime picture, like 5,000 would be nice to have, but that 100,000, that 200,000, that retirement account, that's what I need to live off of,
right? And that you only need one of them, and you only need one of those. To take off to really have some outsized returns there. So, sort of, it's like, having a lottery ticket, I guess, you know what I mean? You only spend $1 or $10 or whatever the Powerball is, and you can make some outsized returns.
But it's better than a lottery ticket, right? Because like, if your lottery ticket doesn't hit, you can't sell it back. Right? But if after like a few years, your stock hasn't hit, well, you can sell it back, and you might have lost some money, but you lose all of it. And with the lottery ticket, you lost all of it.
And it's finite. There's always a chance some of these plays can get picked back up and acquired and all that kind of stuff. So.
Oh yeah, definitely. I've seen. The market's cyclical, and right now we've. Before we were in one of these, low interest rate, basically zero interest rate, which is, a company sees that and they're like, why, free money? And that goes for institutional investors too. They're like, hey, wait, like I can borrow money and not pay interest on it? Oh man, like I'm going to put 10,000 of my own dollars in and $1 million a year.
Yeah, that's we've had this conversation around the office too about interest rates and savings accounts and stuff like that. So, going back to the dividends, how would Apple is now saying, hey, we'll give you 4.6%. A lot of these, like I just called my bank a couple of months ago and was just like, what's up? And they're like, oh, we have this new where it'll give you like 3.9. I probably, and that was a couple of months ago. Maybe it'd be higher now.
That's probably up to 4 something.
Yeah.
Now.
So these banks, when you look at that, how does that affect the market in terms of trying to invest in a dividend stock or something income? Like, granted, that's still not beating inflation.
Right.
So, what effect does those interest rates kind of have on?
It definitely is tough on the income investments, right? So utility stocks are, notorious dividend payers. They always call them like the best stocks for orphans and widows, because they're pretty steady. They don't really go up or down that much, but they steadily pay those dividends. So you get that income to pay your bills with. But the thing is, when a bank account is yielding 4% or, short-term treasuries, I think the 6-month treasuries are up around 5%, and there's literally no risk to those. You're guaranteed to get your money back from the bank. You're guaranteed to get your money back from the government.
Well, hopefully guaranteed.
Yeah, true. There's a lot of things that they can stop paying before they stop paying those bills, though. In my opinion, I think that if we can't reach an agreement on the debt ceiling, they should just send Congress home and not pay them any arrears. And be like, look, once you guys can come to the table and come to an agreement, we'll pay you again. But until then, no.
Yeah, it seems to be a lot of fear out there about the debt ceiling, kind of similar to, this feels like a lot like the 2011, 2012 kind of arena where we kind of came out of the 2008, 2009 situation, but people were still, now back then, they just kind of started printing a lot more money. Doesn't seem like that's really an option right now.
No, definitely not. I mean, it could be, but I'm sure that that politicians would like it to be and would do it. If they could get enough support to do it. But yeah, I mean, printing tons of money is part of what causes inflation to grow because the more dollars you have chasing something, then the higher the cost of that thing is going to be. And it's just basic economics, and unfortunately, they don't teach that in school anymore.
It doesn't seem like they do.
No. I mean, that used to actually literally be part of the home economics courses. Everybody's like, oh, that's where girls learn to bake and clean and take care of a husband. No, that's where you learn how to balance a checkbook, and you learn about interest rates, and you learn about the actual economics of a household. And learning the economics of the household teaches you a lot about the economics of the world, because they're all pretty much the same, the same rules.
Yeah, it seems like that is being taught less and less. Just,
Definitely.
It's
being taught on TikTok now.
Yeah.
By people who have very questionable ideas about, what can be a tax deduction. I saw a bunch of TikTokers talking about if you're in a medical cannabis state, then all of the weed you buy is a medical expense and you can deduct that from your taxes. And you know what? You most certainly cannot deduct that from your taxes. It is not that's like your gym membership. They're like, yeah, your gym membership, that's a medical expense too. I'm like, while going to the gym may make you healthier, it is not a medical expense. And you could definitely get in trouble with 87,000 new IRS agents coming out to audit people like you and me.
Yeah, absolutely. That some of that stuff out there is definitely questionable. We'll probably post this on TikTok too, so maybe people can hit us in the comments. And
right.
It is kind of amazing when you post that stuff out there on social media, and the conviction that people have about things that are just totally wrong. And that's why we just at the end of the day, it's we're providing this information, but it's you need to dig into this stuff yourself. That's basically
we're just sort of hitting the tip of the iceberg. There's so much more to know about it and so much more to learn about it.
Right, exactly. And everybody, people got a limited amount of time, so that's what we hope to provide is a little bit of steering in the right direction. Everybody's got different goals and different time frames,
right, different risk tolerances.
We talked about that earlier. I did want to switch gears to talk about maybe something, I wouldn't say a little bit more risky, but a little bit more high potential, and that's, the lithium craze that has been going on. There was a 60 Minutes. Did you see the 60 Minutes about the Lithium Valley?
I caught some clips from it.
Okay.
Yeah. Lithium Valley, California.
Yeah. So
it's exciting.
And we've been talking about lithium for, forever now, because it's just, the electrification of, particularly electric cars, but just everything that has batteries now.
Because technically we've been the lithium mining industry has been around since the 1970s, 1960s. The lithium ion battery was invented in the 1970s. I think the guy whose name was Good Day. want to say it was Good Day or Good Night or Good Fellow. It was Good something. He made a good battery for sure. Anyway, like ever since then, like that's been, you know, like the best way to power electronic devices. But you know, it really wasn't until the EV craze started that like people really started paying attention to lithium. And the thing is yeah, they use a lot of lithium in EV batteries, but like your cell phone battery, you know, the batteries in like, you know, if these were wireless mics.
Oh yeah, everything.
Anything that's wireless has a lithium battery in it.
Yeah, it's interesting. The focus seems to be on electric cars. And look, I mean, a battery that's in an electric car is like huge compared to your cell phone or laptop battery. But there's like, you know, 1,000 times more devices out there that are using these in small quantities, but it adds up. So the demand is just nuts. And obviously, so it seems like the two, you know, the Lithium Valley, you know, 60 Minutes thing talked about this place out in California. You know, it's U.S. focused. It's, you know, talked about the different technologies that they use to extract the lithium, because it's like kind of it's not like gold mining or something where you're just digging for it.
So like right now, the majority of the lithium that we get to make into batteries comes like from a form of mining that's kind of like gold mining, where you're digging up dirt and putting a whole bunch of dirt into a machine and then subjecting it to really harsh chemicals to strip everything else out, and then you get this fine lithium powder on the other side. And that's what they send off to, you know, I mean, I hate to say it, but to the Chinese companies to make the batteries with.
Yeah.
Excuse me. But the majority of the planet's lithium is actually held in what's known as brine deposits, and that's what they're talking about with this Lithium Valley thing. It's the Salton Sea in California, and so the Salton Sea used to be like it used to be a vacation area for people in California back in the day, and I forget what happened, but like basically like it sort of like was drying up, like and people stopped coming out there, and you know like birds were getting sick. I don't know, but like it's basically it's really really salty water.
Gotcha.
And that's what brine is. Brine is really, really salty water. And lithium can form in salts. You know, everything, like all of the minerals, you know, out there can sort of form in salts. And like we think of salt as like, you know, the stuff that you put on your food, but like a salt it's the chemical structure, the way that the molecules are all bound together. And I won't get into any of the details because I won't get them right. And my parents, who are both scientists, would get very upset with me for that. But basically, it's the way that like they're bonded together, and it can be dissolved in water. Once it gets dissolved in water, it becomes brine. And something like 70% of the world's lithium is held in brine.
Well, it seems like they're in, you know, down in South America, they got these huge, I guess you would call them ponds.
Yeah.
And they're just sort of waiting for it to evaporate so they can kind of.
What they're doing.
Yeah. So
they pump all of this brine in there, and it starts out sort of like a light bluish color, and then like as the sun does its magic over about the course of like 2 to 3 years.
Yeah.
It sucks all of that water out, and then you get the lithium and the other solids that were mixed in there with it, and then you subject it to some pretty harsh chemicals to separate those other solids out, and then you get the lithium. But with that method, you only get about 40% of the lithium that's contained in the brine.
Right.
And like I said, it takes 2 years to evaporate it, and that's after you construct the ponds.
Yeah,
and natural ponds or anything.
Yeah, and you need, I guess, a climate where it's not like raining,
where it's super dry.
Yeah,
you know.
So
it's pretty rough. I mean, it takes up a lot of space. It takes up a lot of water, and as you said, you need a pretty dry climate. So you're in places that don't have a lot of water. So you're using what little water they have to make this lithium. And, you know, so that's why I don't see that happening at this Lithium Valley, California, at the Salton Sea. I mean, like, Californians could literally have all the green energy they wanted to if they hadn't shut down all but one of their nuclear power plants because of environmental concerns. Right. So I totally can't see them being like, yeah, let's have a 100-acre lithium pond. You know, and like, let's just let it evaporate. We'll leave some toxins in the soil. It'll run off into the groundwater. Yeah. Everything will be fine.
Right.
You know, so like, in order for this to be developed, we need these new technologies. And I think they were talking about some of them in the 60 Minutes special.
Yeah, I guess they have a geothermal power plant there that they're saying basically they're injecting the brine, and then they use that, and then I don't know. You've
Well,
been
I mean, that's
researching
sort of how
it more.
geothermal works, right? So, like, it's really interesting because geothermal heat is kind of like fracking. It's kind of like getting brine. And how you get brine is the brine's down in reservoirs underground. And so in order to pressurize those reservoirs, you pump more water down into them. And it pushes, the stuff that was in them up. And that's how, sort of how fracking works. You put the water down there and it sort of like, it pressurizes the rock and fractures it and cracks it open. And that's how geothermal works, where you've got hot water down there in the Earth's crust, and so you pump cool water down there, and it forces the hot water up. You use that as heat, and then you continue the cycle and put it right back down into the ground. So you're already pulling this hot water up. There's a lot of lithium in this hot water, so it's like, hey, why not extract the lithium from it before we put it back in the ground?
Right.
And then that involves a technique that they're still sort of working on. There's a few companies out there that are pioneering it actually in the field, especially down in South America in the Lithium Triangle, where the majority of the world's lithium is supposed to be. And basically what it does is instead of evaporating the water off and getting this sludge, what you're doing is you're almost sort of like dragging a magnet through the water. And this magnet only picks up lithium. Mm-hmm. So it's it's a solution that they put into it that attracts the lithium. It doesn't attract anything else. So basically you can pull out then 99% of the lithium that's available, compared to 40% with the evaporation ponds. And it takes, this is the crazy part, right? 2 days at the longest, 6 hours at the quickest, compared to 2 years with the lithium ponds.
That's nuts.
So you're getting more than twice as much lithium out of it. There's no extra minerals in there that you've got to separate from it. And you're doing it in 2 days instead of 2 years. I mean, it's a huge advancement. And it, like I said, it's one of those new technologies that they're still sort of developing and working on. And everybody sort of has their own method of doing it. But it's like, I use the analogy of finding a needle in a haystack, and the easiest way to find a needle in a haystack is to put a magnet on a string.
Right.
And then you're not pulling out any hay with that magnet. You're only going to get that steel needle.
Yeah, that's amazing. When I first heard you talking about this, it reminded me. So go back 2005, 2006, the oil. Oil was, we first started covering oil. We had predictions of $150 oil, because basically, the world was running out of oil. The peak oil theory had it, the U.S. was just struggling.
Yep.
It actually, I think it ended up peaking around $140 something a barrel at that time. But the reason was the advent of fracking. Yeah. So hydraulic fracturing, really came mainstream in 2007, 2008. Yep. And it was kind of like, if not for that, I mean, who knows what oil would be at now.
It would be crazy.
And I mean, the U.S. was fortunate to
we have lots of that tight oil.
Exactly. So it was a technological advancement that enabled just a huge oil rush in the U.S. and now they're doing it globally.
Well, and it made the process more efficient too. So that was where things sort of backfired on OPEC.
Right.
Because it was the Saudi-led OPEC, and they were like, we're going to crush these Americans. We're going to drop prices as low as possible. And then it turns out that the Saudis and most of the OPEC countries, the majority of their GDP comes from oil.
Right.
So when oil prices, so basically they may have a very low extraction price, right? It may cost them $15 or $20 a barrel to get the oil out of the ground. But then they've got about $60 to $80 worth of social programs tied to each one of those barrels of oil that they've got to support. So that makes their break-even price closer to 100. And
that's to keep the populace from
frackers, their break-even price was the cost of extracting the oil. So
right.
If oil stayed above $25, they were fine.
Yeah, they didn't have to keep Saudi Arabia has to keep a populace in line from revolting against
They got to keep the people happy.
Yeah. So that was basically a huge change. Not a lot of people saw that coming. We were in early on it, and
the Bakken shale.
Real early,
and
just absolutely crushed it in hydraulic fracturing. Oil sands technology, but mainly the Bakken. in like the natural gas plays.
Yep.
So, I mean, is it fair to say this is very similar to that sort of things? Because it's like all you hear is, we need all this lithium to run these things, blah, 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 blah. So it seems like now's the time to get in on, like, basically this is like new this is fracking for lithium, I guess.
It sort of is. And honestly, I think it could be bigger than that, because like the one extra thing that you have tied onto this is that not only does it make lithium mining more efficient and more profitable, but it also makes it more environmentally friendly. Right, so it's more economically viable and it's more environmentally friendly.
Yeah.
Fracking, I mean, there's a debate on that,
right?
Whether or not it's bad for the environment or whatever. But I mean, there's not much debate on whether or not burning fossil fuels is bad for the environment. We can see the smoke come up when you inhale it, you cough. Like, it can't be that good. So. But this, it's better for the environment. It's better for everybody. It's better for the people in the surrounding area. You don't have to use up their land to make those evaporation ponds. You don't have to steal their water, to fill the evaporation ponds with. You don't have to worry about runoff because it's all done inside of a factory, which can be built on site, and does not take up hundreds of acres. It just makes everything better for all of the different stakeholders. And I know that like people are probably tired of hearing about stakeholder capitalism and stuff like that, but like you do you need to look out for everybody, right? I always use the example of BJ's Wholesale Club and Costco Wholesale Club, right? They're both publicly traded stocks, so you can check out their performance and you can check me on this, right? But BJ's is kind of more like a Walmart, right? Where they hammer their suppliers and they try and get the lowest prices they possibly can. They have pretty high employee turnover. Their revenue per employee is not that impressive. But then you go to Costco, and Costco works with its suppliers and it works with the communities around it, and it has incredible employee retention. And I think its revenue per employee is something like $17,000 per employee, which is like super impressive when you think about, how many employees they have, But a story that I love to tell about Costco is Costco, they negotiate hard too with their suppliers, but they negotiated this supplier down to like a ridiculously low price. And they went back, and they were like celebrating, but they were also calculating, and they were like, wait a minute, this guy's not making a profit. And so they called the guy the next day and they were like, look, we need to renegotiate the price. And he's like, I can't go down any lower. I will go out of business. And they were like, we know. We want to pay you more because we want a long-term relationship with you. We don't want to put you out of business, just because you want a big customer. So we're going to pay you a little bit more money so that you can make a profit, so that you can grow your business and you can be a long-term partner of Costco.
Yeah,
and
that's long-term thinking.
The difference between their stock prices, Costco has outperformed BJ's by leaps and bounds.
I personally am a Costco member. I like it a lot. I got the membership card.
That Kirkland brand, man, that's some good stuff.
But I definitely like it a lot better than BJ's for sure. And they got both in my town. So
okay, all right.
All right. Well, I mean, it sounds like lithium. The fracking for lithium, as I was called,
I'm excited about it.
Yeah, is a big. I've been hearing more about it. Like I said, now it seems to be like kind of the turning point when it's on 60 Minutes. I remember when they were doing that on like the oil the Bakken and the fracking stuff. You want to get in before the mainstream sort of like picks up on it.
Yep.
And
that's the cool thing is right now, I was just talking a little bit earlier about somebody was asking about like who's the biggest, lithium miner in the country. And I was like, oh, it's kind of funny. That's actually also the biggest lithium miner in the world, this company Albemarle. But one thing Albemarle is not really working on in the field yet is this new type of extraction. And it's because big companies like that, they don't like to take risks on new technologies. They want to see other companies, implement it. They want to see how successful they are. And then, hey, we've got billions of dollars. We'll just buy this other company and use that technology. So you're still at a point where these big players haven't really gotten in on the game yet. And it's all, smaller, mid-sized companies they've got less to lose. So they're like, hey, maybe this will let us catch up to those guys. And, that's the really exciting part.
Right. So the companies you're looking at are the smaller players that have developed this technology and are potentially, buyout targets for these bigger guys.
Yeah, definitely. And what's really cool about the lithium industry, and it's also pretty cool about, just about any mining or extraction, natural resource extraction industry, is that they say the best place to find a good gold mine is right next to a good gold mine, because like resources don't respect boundaries that are set by man, right? So, if your neighbor has a bunch of gold on his property, chances are you got a bunch of gold on yours. If there's oil right here, there's probably going to be oil right next to it. And if there's like a bunch of billion-dollar lithium companies right here and your location's right there, dude, you're going to be a billion-dollar lithium company one day. And so, that's what's really neat about it is you can find these little companies on a map and be like, hey, man, they're right next to, POSCO, this, like $5 billion South Korean giant. They're right next to like Livent that just got acquired by, Alchem. In like a multi-billion-dollar transaction, like, hey, like if these guys have good assets right there, then a couple miles south, they're probably still good assets. So that's what's really neat about this is you can go and you can, find these small companies, and it's not quite like those lottery tickets we were talking about earlier. The risk is sort of mitigated by the fact that they are already right next to, a peer that has very deep pockets and that's already been very successful in that area. So, either they're going to be very successful in that area, or the peer with the deep pockets is going to be like, hey, thanks for developing that. Let me buy it from you.
Gotcha. And you're
and these companies get bought at like 50, 60, 70% premiums. Like probably higher these days, to be honest.
Nuts. Yeah. And these are the companies that you're looking at in Future Giants.
Yeah, that's my small cap investment advisory service.
So completely sort of different than the Dividend and sort of income-driven plays of the wealth advisory.
Right, that's what I look at in the wealth advisory. And actually, Albemarle is a holding of ours in the wealth advisory. We're up triple digits on it. It pays us a steady dividend.
That's awesome.
It's a great company.
Cool. Well, what we'll do is we'll put a link in the description on how people can join Future Giants.
Yeah, I actually have a whole report on this.
Okay, we'll put that in the description.
That I'd love for everybody to read.
Yeah, we'll put that in the description. People can learn about this technology. I'm like pretty excited about it. It seems cool, and I'm gonna go check that out. And because some of these, if it is anything like the fracking boom, like people are gonna clean up.
Oh yeah.
So
I expect it to be very similar.
All right. Well, that about wraps it up. And thanks again for
of course. Thanks for having me
on.
It's always good to be around another Jason.
Absolutely.
We got to support each other.
Yep. Make sure you subscribe, just subscribe. I don't even care if you like it. Just subscribe to the podcast.
I mean, I prefer a thumbs up than a thumbs down.
No, thumbs up are good. Or comment. You can if it's on YouTube, you can comment.
Comments.
Yeah. And even
even snarky comments.
Yeah. I appreciate a good snarky comment. That's good.
I make them sometimes.
Yeah. All right. Thanks for joining us. Goodbye.